China's stocks hit rock bottom. After a $6.3 trillion market loss, brokers suspend short selling. So you can imagine the chaos that's unfolding in China. The Chinese economy is plunging amid snowball derivation liquidations. China's stock market is falling faster than its population. The Hang Seng China Enterprise Index crashed 6.5% this week alone, its worst weekly loss since March 2023, with Wednesday seeing the biggest daily loss since October 2022, as the index plummeted to key support levels around the October 22 lows. Source is Bloomberg. For context, Chinese and Hong Kong stocks have seen some $6.3 trillion of market value wiped out since a peak reached in 2021. And again, source Bloomberg. As detailed earlier in the week, authorities have ruled out the use of massive stimulus to revive the flagging economy of China, leaving traders wondering when things are going to improve. What we're seeing this year so far really is a continuation of what we saw last year, said John Lin, AllianceBernstein's chief investment officer of China equities. That's what he said just 2 days ago, January 17, on a Bloomberg interview. These squeezing the toothpaste type stimulus policies so far have not been able to turn around the underlying bottom-up fundamentals of areas like the property sector. It gets worse as China is setting grimmer and grimmer milestones by the day. Tokyo has overtaken Shanghai as Asia's biggest equity market. India's valuation premium over China has hit a record. Locally, a meltdown in Chinese shares is wreaking havoc on the nation's asset management industry, pushing mutual fund closures to a 5-year high. Most importantly, as noted, the lack of stimulus amid China's real estate sector crisis and escalating tensions with Washington on trade has had a very adverse impact on both economic and market sentiment at a time when Chinese middle class is growing increasingly restless and pitchforky, resulting in a surge in labor strikes and most peaceful protests. And while a quiet, painless sovereign suicide may be an option for Japan, its demographic disaster and rapidly aging population, where more adult and baby diapers have been sold for years. For China, which still has a young, vibrant, and increasingly angry population, this is not an option, as the coming tidal wave of unrest could easily result in the one thing the Chinese Communist Party dreads the most, and that is a revolution. For now, Beijing refuses to unleash a monetary bazooka amid its longest period of deflation since 1998, but that does not mean it won't step in to try and arrest the collapse of the stock market, which, along with the real estate the real estate market, is a considerable source of wealth, of course, for the Chinese. The government seems very sanguine about the economy, said Qi Yaoneng, an investment director for Asian equities of ABRDN. The market might not even trust the 5% growth figure. It certainly has a much more negative view on the economy and definitely believes Beijing needs a big fiscal response. Let's remember that maybe the numbers coming out of China concerning China's economy, the 5% growth rate, are not true. Now, with that in mind, just a day after unleashing the national team, China Plunge Protection Team, Bloomberg reports that China's largest brokerage has suspended short selling for some clients in mainland markets, according to people familiar with all this. State-owned CITIC Securities Company has stopped lending stocks to individual investors and raised the requirements for institutional clients this week after so-called window guidance from regulators said the people asking not to be identified discussed a private matter. Of course, we've pointed out numerous times, research has consistently shown that banning short selling during stretches of particularly volatile equity market activity intensifies the volatility. Such prohibitions impede investors from determining accurate prices of assets and reduce market liquidity, of course. Moreover, short selling bans in one market can increase volatility in other markets as some investors try to circumvent the ban. But since when has historical evidence of the failure of policies ever stopped any politician from doing something or blaming someone? Everything that Chinese authorities have tried has failed to convince money managers that the worst is behind us, and Bloomberg reports Asian funds have cut their allocation to China by 12% points to a net 20% underweight, the lowest in more than a year, according to the latest Bank of America survey. Managers of benchmark tracking funds have sold a net $300 million of shares traded in mainland China and Hong Kong this month, according to Morgan Stanley. That's a reversal from the last half of 2023, when they bought $700 million on a net basis, even as stock indexes declined. China is a waiting game, and we continue to be waiting, said Mark Matthews. He's the head of Asia research at Bank Julius Baer and Company, which is mostly avoiding Chinese equities. How much longer can Beijing wait, though? So this is a chaos happening in China, and we'll see what happens, on Monday, when the markets open again. This is by Tyler Durden on Zero Hedge. Please leave your comments. Thank you for your support. Kindly support my Patreon account. The daily posts are 5 videos daily, and they are totally different from what I have on my YouTube channel. Thank you so much for your support and that you find all my content so interesting. You'll find the Patreon account details in the description box below.